Is it possible for you and me to make money by investing in water companies? Well, I investigated the 139 publicly listed water stocks. I don't believe there's more to check if a finance noob, but a water nerd like me, could find out some patterns that would enable us, the small plebeians, to beat the Wall Street gods on their very field. Now, this is not investment advice, but it's the result of my patient assembling and crunching hundreds of market data points, yearly reports, and other financial sleeping pills, and it doesn't come from nowhere either. Through the years on this channel, I've looked at how large companies invest, sometimes by acquiring each other. I've looked at how private equity invests, sometimes by acquiring stuff from each other. And I looked at how venture capital invests, and no, they don't acquire anything from each other. They're too early for that. If you're a big ticket investor, that's one-to-one useful for you. Happy if I helped. However, if, like me, you're just ready to invest what you're willing to lose, then you need to aim for smaller tickets, and that's how stock markets become an alternative. But is water even an investment thesis on public stock exchanges? Actually, yes. You can buy a water ETF, the largest probably being BlackRock Swan, and boom, off you go. If water companies do well on the S&P Global Water Index, you'll do well as well. But given the quite specific nature of the water sector, water ETFs are all passive, meaning there's nobody in the driving seat and you're just hoping that a rising tide lifts all boats. Over 2024, that would have yielded you a 7.6% performance. Not bad. Yet, if you want more control over your destiny, you can invest in a water thematic fund. The largest this time being Pictet's Water Fund. These funds have asset managers that actually take strategic decisions, which means there is someone in the driving seat, and as a result, in 2024, they averaged a performance of 8.3%.
That's victory right there.
I know, it's not spectacularly more, but it's something. Now, there may be a reason why thematic funds don't do spectacularly better than passive ETFs, and it is quite logical when you think of it. I discussed off-record with asset managers at 3 of the 4 largest water funds, and they all told me the same. There are not enough water stocks, so not enough baskets they can put their eggs in, and in turn, that hinders their ability to manage their portfolio very actively. A clear sign of that is that you can't actually invest in Pictet. The fund is closed since 2022, and if you were not in by then, well, screw you, you're not in. Don't look at me, I'm not in either. That's how the Pictet asset managers can protect a bit of their ability to be agile. Indeed, the total market capitalization as of today of water pure players is about $122 billion, and as Pictet alone is about $10 billion, and all active funds together a bit more than $30 billion, you see how that would quickly become a problem if they want to move fast, especially when you also compound in the $10 billion or so that sit in the water ETFs. So this is the context in which I very proudly thought, wait a minute, maybe being small and agile can become an asset, especially if I had some sort of water intelligence that finance moguls wouldn't have. And that's the context in which I almost by accident got hold of this document. Nothing illegal in that accident, don't worry. It was distributed in a roundtable I attended at the Global Water Summit. What this is a research report from RBC Capital Markets simply titled Our Water Sector Investment Framework. It looks like a boring PowerPoint at first with quite generic water information, but where it caught my eye is in the last section on pages 18 and 19. First, because I'm an engineer, I like graphs. Second, because I was wondering how much of that line drawing was wishful thinking. I'm an engineer, I like to be a contrarian. But also third, because this super nice correlation between M&A valuations of water companies and market valorization of water companies was built upon the understanding of what the water company actually does. And that's where I thought, if I stop a trader on Wall Street and ask him in a heartbeat, what does Ecopac, Acea or Georg Fischer do? It's almost certain he wouldn't know. But I know. I'm a water nerd and I work for Georg Fischer, so I know what Georg Fischer does. Great company. So seriously, that could be my unfair advantage and my chance to become a successful water stock investor, and so, in turn, yours as well, as I'm sharing today. But isn't that correlation and that curve too nice to be true? That's what we'll have to verify first. To do so, I read yearly reports and gathered data from the 139 publicly listed water companies I mentioned in the introduction, and to get to those 139, I actually had to loosen a bit my definition, as those are not water pure players, but all the publicly listed companies with more than 30% of their revenue in water endeavors. Once I had the data, the first thing I wanted to check is the one that questioned me the most about RBC's approach. To draw their curve, they first built a pyramid of coolness in water technology that they call the valuation continuum best in breed. It starts with pipes at the bottom, which breaks my heart as a GF guy, but which I yet understand. And it goes all the way to the top with smart water networks being the coolest of the coolest, which again is not that surprising. What's more surprising to me is how UV disinfection, for instance, is very close to the top, while I would deem that field to be pretty commoditized nowadays, while automation was stuck in the middle and desalination the second best in class. Who says that? I don't know, but if it's the market, then maybe the market doesn't have a very accurate vision of water tech, which, again, could be interesting. So I decided to skip RBC's insight and run my own categorization of water companies to then do the same exercise as them and map the enterprise value on EBITDA ratio against the various companies' verticals. RBC broke the water sector into 18 categories, but I said it several times now, I'm an engineer, so I like to overcomplicate things, and I actually broke it down into 25 categories, not just because I could, but because I thought that was a more accurate depiction of the way the market is split, at least in my eyes. And what I found is not just one insight, but actually 7. Let me start with the summary and then I'll break each of them down. First, let's zoom out before we zoom in. Water companies exist in a Goldilocks zone, not too hot, not too cold, but potentially undervalued given their strategic importance. That's good news. It means investing in water seems to be a sound strategy. My 139 water stocks indeed trade at a 12% discount to the S&P 500, despite having defensive characteristics that should command a premium, especially in this day and age. Now, that being said, small caps are a disaster zone. I know I already said that on this channel, link in the description if you missed it, but that also means that, by contrast, some other areas show good potential. And yes, RBC Capital Markets is right, as we'll see in my finding number 5, there is a secret valuation hierarchy that runs from boring pipes at 9.5 times EBITDA multiples to hype cloud platforms at 35x EBITDA. Who would have thought that cloud is sexier than pipes, right?
Everybody.
So let's dig into the juicy details, because that's where the real opportunities hide. But before that, you know what else could be hiding? Yes, contaminants in your water, which you wouldn't know if it wasn't for my sponsor, SimpleLab. If you're in the water industry, SimpleLab has you covered. SimpleLab is your one-stop shop for certified laboratory testing kits, from routine lead sampling to walk-ins and specialized analyses like microplastics, PFAS, and RADs. Order the testing you want online, choose from hundreds of accredited commercial labs, and get free round-trip shipping both ways. By the way, if you have your own lab and just want help with kitting and logistics, SimpleLab can do that for you too. No more coordinating labs, chasing shipments, or wrangling EDDs, just streamlined ordering, clear results, and real support when you need it. It's lab testing simplified, so head to gosimplelab.com. It's the first link in the description. Choose your tests and they'll take care of the rest. Thanks SimpleLab for supporting my work. And back to my findings with number 1, the great business model divide. Indeed, that's the first pattern that jumped out. Not all water companies are created equal. In fact, there are 3 distinct categories in the water world, and they trade at dramatically different valuations. You have the equipment folks first, companies making pumps, meters, treatment systems. They trade at a median 14.2x enterprise value over EBITDA ratio. If you don't mind, from now on I'll just mention the multiple, but so you know, it will always be about this EV over EBITDA ratio. This is the bracket where we'll find Xylem, Pentair, Mueller Water. Think of it as the companies that make the sexy hardware everyone seems to want. Then you have the service companies, utilities, operation companies, the guys who actually move water from A to B and ensure it flows at the tap. On average, they trade at just 11.5x EBITDA. Yes, they feature some rock stars like American Water, but if we're honest, these are the steady eddies, the dividend aristocrats.
You can't say it, can you?
The companies your grandpa would buy. And finally, we have the mixed models, companies doing a bit of everything that sit in the middle at 12.8x. How would I define them? Well, they're like the Swiss Army knives of water, I guess. So you now may be thinking, no shit, Sherlock, investors prefer tech over utilities. I know. Thank you, Captain Obvious, but what's interesting is to understand why. This 25% premium for equipment companies is not just a random market noise, I believe. It reflects a fundamental truth about the water sector. Investors pay up for companies that make things rather than companies that operate things, because equipment companies can scale globally while utilities are somewhat stuck in their geographic perimeter. I know that you can go hunt outside of your geographic kingdom, but ask Suez how easy that is when you don't have tech to support you in that endeavor. So what's in it for us, small investors? Some service companies are trading at equipment multiples despite being boring utilities. That's either a mistake or an opportunity, depending how you look at it. Second finding, and I know, Captain Obvious again, profitability is king for a listed company, and the market is ruthless about rewarding it. I found it to be the strongest predictor of valuation in the entire dataset. Stronger than geography, stronger than business model, stronger than size or vertical. Companies with EBITDA margins above 40% trade at a 40% premium to everyone else. Every 10% increase in margin correlates with a 2.5x increase in valuation multiple. Think about that for a second. A company with 45% margins will trade at roughly 18x EBITDA, while the company with 15% margins trades at 11x. Same industry, somewhat same customers, but the market values efficiency like nothing else. And this creates opportunities. I found several companies with 30% plus margins trading below 12x EBITDA. Either these companies are about to collapse, or the market hasn't noticed their efficiency yet. Given that water demand doesn't exactly disappear overnight, I'm betting on the latter. But if some highly profitable companies underperform, hence becoming good investment opportunities, 14 companies in my dataset also have a negative EBITDA. There are a couple of exceptions to it, but most of those are companies that burn cash in their growth stage and the market is not that supportive of it, to use a euphemism, but we'll come back to that in my finding number 6. Before that, I believe finding number 3 takes us out of obvious territory. There is a strong geographic arbitrage. I mean, ask even a water professional for 2 water stocks, and I bet you a good bottle of wine that the 2 first answers you'll get are Xylem and Badger Meter. 2 US companies. In fact, North American water companies trade at 16.5x EBITDA on average, European companies trade at 13.5x, and meanwhile, Asian companies trade at just 11x EBITDA, which is a 50% discount to their American cousins. Now, you might think this discount is justified. Maybe Asian companies are lower quality, higher risk, you name it. But when I dug into the fundamentals, I found Asian companies with similar margins, similar growth profiles, similar business models, similar verticals, trading at massive discounts simply because of their headquarters location. We're talking about solid operations in Japan, South Korea, China, established players with decades of track records, but that are not listed on the New York Stock Exchange. Suppose you're Gradient and you're believed by many, maybe me included, to be up for an IPO in a not-so-distant future. Your headquarters is in Boston, but most of your active forces are in Singapore or Abu Dhabi. If you decide to do your listing in Asia, your valuation drops by a third compared to a US listing. There's no rationale for that. That's pure market inefficiency, and that's maybe an opportunity. So for my finding number 4, remember that coolness pyramid from RBC I mentioned. Turns out they weren't entirely wrong about the market's obsession with technology. Companies with more than 5% digital revenue trade at a 65% premium, 18.5x EBITDA versus 11.2 for purely analog companies. Now, digital is a bit vague, so let's be specific here. We're not discussing generative AI, but adding sensors to water meters, putting control systems in the cloud, basic digitization that many other industries did 15 years ago, yet the market is treating this like it's the invention of the internet. I know it's a shortcut and there's more to it, but adding smart to your product category triggers a 60% valuation jump. A regular water meter company trades at 14x EBITDA, while a smart water meter does so at a 22x multiple. Same water, same house connection, but now it enables more digital layers and suddenly it's worth 60% more for investors. Don't get me wrong, I'm not downplaying digitization here. I'm just saying this creates two opportunities. First, you can invest in companies undergoing digital transformation and ride the revaluation wave. But also the other way around, you can plan on shorting companies trading at tech multiples for having undergone that digitization, because once it's done, that market will realize that a smart water meter isn't exactly an iPhone. You don't change it every year just because it now comes in sidereal gray. And again, don't get me wrong, I'm not on digitization itself. I'm considering the opportunity to see through the buzzword some are sometimes hiding behind to use it as our unfair advantage as water nerds. But talking of water nerds, it's time for my long tease finding number 5, the boring to hype spectrum, and its ranking of all 25 water subsectors based on their correlation with valuation multiples. And yes, at the bottom, the boring end, we have pipes trading at 9.5x EBITDA. Pipes, the most essential part of any water system, if you ask me, and the market treats them like the Paris Saint-Germain looks at Kylian Mbappé with a sorry, not sorry smile while holding the Champions League cup. Sorry, I digress quite a lot here. I'm biased and I, of course, contractually have to say that. But back to serious, at the top, the hype end, we have cloud platforms trading at 35x EBITDA. Yes, the market values them at nearly 4x what it values the pipes. Now, what stands out in that boring to hype spectrum is the combination of 4 parameters that, taken together, enable us to predict with solid accuracy the EV over EBITDA multiple. Here's the formula. EV over EBITDA equals to 8.5 plus the position in the spectrum times 1.1 plus 15 times the percentage of revenues made in digital plus 8 times the percentage of revenues that's recurrent. So yes, every step up in the technology ladder I'm showing you here and in the newsletter if you're listening to the podcast adds about 1.1x to your multiple. But if you want to put that multiple on steroids, add some digital components and you get a 15x multiplier, while recurring revenue gets you another 8x boost. For companies, it's like a video game where you collect power-ups for higher valuations. As a shrewd water nerd turned investor, it's a hint at scouting companies about to make a big splash in either digital or recurring revenue, or even better, water software as a service. Remind me, if Transcend ever IPOs, I'll buy. Still not investment advice. And actually, for Transcend to IPO right now would probably not be a good idea, because as teased as well, my funding number 6 is the one where I have to unfortunately hurt some feelings again. Small cap water companies are a graveyard of broken promises and destroyed capital. The numbers are brutal. 14.1% of small caps are unprofitable versus 0% of large caps. Small caps are down 42% from their yearly highs on average, not even historic highs, while mega caps are down just 19%. Why is water so particularly harsh for small companies? Well, it's a combination of two dangerous factors. First, those are too small to get an investment from a passive ETF. As they're not in the S&P 500, they're not de-risked enough at the stage they IPO to be a wise and safe bet for the managed water asset funds, and hence, they only get pumped unintentionally by small shareholders that believe a tad too much in the great promises that these otherwise great companies do. But then the second factor hits and the water timelines prevent those companies from achieving their goals within their shareholders' patience window. They divest and the stock goes through the floor. I've made an entire video about it, but the IPO disappointment pattern is depressingly consistent. First, revolutionary technology story gets funded, then reality hits, water customers move slowly, then cash burn continues, revenues don't materialize, then stock collapses by 90%, and then company disappears into the small cap wasteland. There are so many of these stories, companies with brilliant technology and passionate teams all trading for less than their cash on hand because the market has given up on them. As we'll see in the last part, though, and that's where I really have to insist that this is not investment advice, that it's risky and you should not invest more than what you're ready to lose, but I believe that a water tech investor could take some informed risky bets on those small caps. More to that in a minute. Before that, I want to finish my 7 findings section with a more positive touch. When I compared water stocks to other sectors, I discovered something interesting and maybe a safer long-term bet. Water trades at a 12% discount to the S&P 500. despite having defensive characteristics that should command a premium. I already said that. But think of it, if water scarcity is now on the critical path, it makes sense that the sector solving the bottleneck long-term trades at a premium. Today, it trades at a 29% discount to clean tech despite being more profitable and stable. And the other way around, it only trades at an 8% premium to traditional utilities despite having significantly more growth potential. I'm only slightly biased, but we have an industry that's essential for human survival, benefiting from massive infrastructure spending, experiencing digital transformation, protected by regulatory moats, offering inflation protection through rate increases, and solves for the issues that will represent 80% of climate change's impact, and it's trading at a discount to the overall market. Either I'm missing something fundamental, or the market is undervaluing the strategic importance of water infrastructure. Anyways, I've got a bonus finding, which I didn't dare to include in my 7 findings structure because as much as I may believe my water nerdness is a plus for a lot of the previously mentioned, well, here, finance specialists will laugh at me, but here we go. Still, there's a sweet spot when it comes to dividends. What I found out while digging in these water stocks is that traditional utilities pay 3.2% dividends on average, which sounds great, right? But yeah, there's a catch. They're paying you that much because they have a harder time to grow, which is only partially true, as we've seen American Water acquire 47,000 customer connections in 8 states just 2 weeks ago for about $350 million, but still, that's the exception. Public water utilities are often mature, regulated monopolies stuck in their geographic boxes, and dividends are basically their way of saying, we can't figure out what else to do with this cash. Take it. Other water companies, on the other hand, and on average, are paying 2.1%, which is lower than utilities. Yes, but they're choosing to pay it. They're not forced to. They could easily reinvest that cash in what we've listed before: growth opportunities, international expansion, or digital transformation. And there's basically 2 ways to look at it. Sure, it shows the ability of water companies to generate cash, but it may also signal the difficulties of this sector to execute and spend its cash, which we've seen when the World Bank highlighted that only 72% of water budgets are spent. Anyway, the geographic divide we saw in the arbitrage insight also exists when it comes to dividends. Indeed, Asian water companies are not only undervalued compared to their Western peers, many of them are also paying 3 to 4% dividends, while again trading at a 50% discount. You're getting utility-level dividends from companies trading at growth stock discounts. It's like a perfect storm, which makes for the smoothest of all the transitions to the investment playbook I'm taking home from that investigation. Because insight is great, but how do you turn these into actual returns? I'm gonna give you 3 distinct strategies. Think of them as the conservative, moderate, and aggressive approaches to water investing. Choose your own adventure based on your risk tolerance and how much you trust my spreadsheet skills. Remember, this is still not investment advice, but I actually have some advice for you, and it's to check out my second sponsor, Bluefoot Membranes. Have you ever heard of a membrane that refuses to break? It sounds incredible, but it's true. Meet Bluefoot Membranes, a Belgian company that has developed the first and only unbreakable membrane specifically designed for MBR. If you're new here, membrane bioreactor applications. This technology is setting a new standard in wastewater treatment. Water engineers and industry experts have tested this membrane, and no matter how much they pull and twist, the membrane holds strong. Now, it's not just about membranes, it's also about an award-winning and passionate team that doesn't take impossible as an answer. The people at Bluefoot Membranes are driven by a mission to make wastewater reuse the new standard, united by a shared purpose to leave a blue footprint on the world. So yes, they manufacture cool membranes, but they also push the boundaries of what's possible in MBR technology. To learn more about them, check the link to their website in the description. A big thanks to Bluefoot Membranes for sponsoring this episode, and let's move to my first strategy: the boring money portfolio. This is for investors who want water exposure without the drama. You're not trying to get rich quick, you want steady returns, decent dividends, and the ability to sleep at night without checking your portfolio at 3 in the morning. The rules are as follows: only profitable companies, positive EBITDA, period, a market cap above $1 billion, liquidity and stability, an EV over EBITDA between 8 and 15, which is reasonable in valuation, and a dividend yield above 1.5%, which means you're getting paid to wait. In terms of geographic focus, we'll go for North America and Europe. I honestly internally battled with that one because I don't see why those would be deemed more stable than Asia, especially in the current US age, but I'll give in to herd mentality on that investor profile, which would be our conservative one. The target allocation would be 40% regulated utilities, the likes of American Water or Severn Trent, the companies that move water from point A to point B and bill their customers to do so, then 40% essential equipment, Xylem, Pentair, the companies that make the pumps and pipes, obviously GF, and finally 20% mixed models, companies doing a bit of everything for diversification. This portfolio should give you roughly 12 to 15x average EBITDA multiple, 2.5% dividend yield, and the warm, fuzzy feeling of owning infrastructure that civilization literally cannot function without. It's not sexy, but it's safe. And still, without promising anything, I don't know how many legal disclaimers I have to do to be safe, I guess you can expect returns between 8 and 12% annually with low volatility. So that's strategy number 1, not reinventing the wheel here. It's something we discussed a couple of times with Nicolas Ravelot on the podcast. Link in the description if you missed those, and if you can't stand my voice from years ago. Let's move to a bit more exciting waters with my strategy number 2, the digital transformation play. This time, we build around my favorite finding that the market is paying massive premium for digital transformation in water, even when it's just pretty simple digitization that other industries did a while ago. The thesis would be to buy companies in the middle of transforming from analog to digital and sell companies already trading at full digital multiples. So the target companies would be traditional meter companies adding smart capabilities, which is the transition play, equipment manufacturers building IoT sensor layers, utilities implementing smart water networks, and company with 1 to 5% digital revenue that could grow to 10% plus. And this is probably the tricky part because that's where we have to make an informed guesstimate. Anyways, we want to avoid pure software companies trading at 30x plus EBITDA. The hype is already priced in. Revolutionary technology companies with no revenue because we're only moderately risky in that strategy. And overall, anything trading above 25x EBITDA without exceptional growth. Our portfolio construction would probably resemble something like this: 50% transformation companies, which are traditional players going digital, 30% digital leaders, companies with proven digital revenue streams but not yet to their full potential, and then my little trick here, 20% geographic arbitrage, Asian companies with digital capabilities trading at discounts. So the key metrics to watch would be digital revenue percentage, with a target to grow that from 2 to 8% plus, a recurring revenue mix, knowing that software and services are growing faster than hardware in that bracket, and customer adoption rates of digital solutions. Let's be clear, this strategy requires more homework. You need to actually read earning calls and understand which companies are serious about transformation versus which ones are just adding smart to their marketing materials. But with all the due disclaimers, you could expect 15 to 20% annual returns if you pick the transitions correctly with moderate volatility. Now, if you don't know what you're doing, stop here. If you're in for the adventure, let's go to strategy number 3, the geographic arbitrage portfolio. On the paper and without spending my money, because remember, all of this is theoretical, this is my personal favorite and probably the highest conviction strategy based on the data. The idea is simple: buy quality water companies trading at 50% discounts, simply because they're in the wrong zip code. From what I've seen time and time again, I have no way to believe that Asian water companies would be worse by any stretch of the imagination than their Western counterparts, granted you compare apples with apples. And you know what? I might not even push the risk up until picking Chinese water developers, because there the unfair advantage is to have Chinese information, not to have water understanding. So I don't want to overestimate our water nerd power. So the target profile would be Japanese, South Korean, and maybe Taiwanese water companies with established operations, 20 plus years in business, profitable with 20% plus EBITDA margins, and trading below 12x EBITDA, which is still a 50% discount compared to US peers. Last but not least, it would come with dividend yields above 3%. If that sounds like the five-legged sheep, I'm not giving names on purpose, but trust me, they exist. Now, to manage risk, we would focus on companies with some international exposure and diversify across multiple countries. I really believe this would work because we've got same business fundamentals as Western peers, often better regulated than US utilities, higher dividend yields, and probably last but not least, most US investors never heard of these companies. I mean, not you. You are a stellar US water investor because you listen to me, but the others, they're bad. They're not even subscribed. You are subscribed, right? Just check it to be sure. The idea with this approach is to get the same kind of returns as with strategy number 2, so let's say 18 to 25% annually if the valuation gap closes, but to double that with a 3 to 4% dividend yield, higher currency and regulatory risk, maybe, but potentially massive returns. Finally, to round off that segment, I have a bonus strategy here. Again, for the truly adventurous, I call it the small cap treasure hunt. And yes, I know what you're thinking. After spending 10 minutes explaining why small cap water companies are basically financial quicksand, am I really going to recommend some? Well, yes, but with massive caveats and a very specific framework. First, let me preface that. The vast majority of these small cap water companies are nothing else than growth stage gems that probably IPO'd too early. Would they be in a VC portfolio who's ready to take zeros? They would be great moonshots. It's just not the type of play you can reasonably bet your kids' education money on. Kind of right player at the wrong place, if you see what I mean. So even if I still believe that a huge majority of small cap water companies are value traps waiting to happen, there are few patterns in the data that suggest some might actually be diamonds in the rough. So here would be the criteria, and mind you, all must be true. The market cap must be between $200 million and $800 million, so it has to be liquid enough to exit, but small enough to be overlooked. The company must be currently profitable with EBITDA margins above, if not 20%, at least 10%. They should experience a year-on-year revenue growth above 10%, have a debt to market cap ratio below 50%, they should be trading below 15x EBITDA, and I know this may sound oddly specific, but there are more than a dozen companies in the dataset that fit those criteria. Then once you've passed that qualification hurdle, I would see 3 attractive profiles: the regional monopoly play, the critical component play, and the profitable niche technology play. Let's be clear here, what we're really betting on is not that these companies will become the next Xylem. We're betting that they'll get acquired by larger players, or they'll grow into mid-cap status with mid-cap multiples, or that the market will eventually notice that they're profitable small companies in a growth industry. And to go full circle with my preface, this is venture capital with training wheels. Most of these bets won't work out, but the ones that do could return 3 to 5x your money. Or you could become a limited partner in a VC fund with adults in the room that know what they're doing in those early stages. Your call, but if that's of interest, I've dropped a link in the notes below to my ultimate database of water investors. Check it out, it's entirely free, no strings attached other than receiving my weekly newsletter, and if you're not subscribed yet, consider doing so, because I have a great episode with a great VC coming out soon, as I sat down with the Pure Terra team a couple of weeks ago. Something you don't want to miss, honestly, and I'm again only slightly biased. Let me now conclude with what dozens of hours of data crunching taught me. Water investing is definitely not about finding the next Tesla. It's about finding systematic mispricing in a market that most investors ignore and some more misunderstand. I truly believe that if you're ready to do the water market watch, you can widely de-risk a mix of strategy 2 and 3, so digital transformation companies in undervalued geographies. If I want to be caricatural, buy the Asian smart meter company that trades at 12x EBITDA instead of the American one trading at 22x. Similar technology, same market opportunity, half the price. And remember, we're not just investing in stocks, we're investing in the infrastructure that keeps civilization running. When everything else falls apart, people will still need clean water. Some call it a bet on an investment thesis. I call it a bet on human survival. So let's let Wall Street chase the next AI unicorn and BlackRock invest in all water stocks in an undifferentiated manner through its ETFs. And let's use our water brains to beat them on their very field. And don't sleep too much on it, because finance guys have a well-constructed brain and they're actively seeking water and water intelligence. If you click here, you'll get my first-hand experience of that happening a couple of weeks ago at the Global Water Summit, aka the Davos of Water. In the meantime, make sure to subscribe, and if you do, I'll see you next time.